Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, February the 15th, the day after Valentine's Day. I hope you guys didn't get in too much trouble with your significant others and got them something, at least candy or something, right? Flowers maybe. All right, anyway, my name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you these different strategies, but it's up to you to implement them in your portfolios in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data. We actually have some pretty decent economic data here in the United States, not so much across the pond, but here in the United States, we got PPI, came in at 0.4%, right in line with expectations. Remember, PPI is Producer Price Index, and then the core PPI, which strips out food and energy, increased to 0.4% from 0.2%. So that's supposedly good, but everybody likes paying more for food and energy, right? No, not so much. But if the overall economy is driving that inflationary pressure due to supply and demand, then that is a good thing. All right, then on to Empire State Manufacturing Index came in at 13.1, lower than the expected 17.7. So a little bit of a pullback here in the Empire State area. And then we got Philly Fed Manufacturing, came in a little bit higher than expected at 25.8, expected to be 21.5. Unemployment claims came in at 230,000, in line with expectations there. And capacity utilization rate pulled back just a little bit to 77.5, expected to be 78. And then they revised last month's number down from 77.9 to 77.7. So not much of a revision there and not much of a miss on capacity utilization. Industrial production, though, did come in at a negative 0.1%, expected to be a positive 0.2%, and they revised last month's number down quite a bit from 0.9% to 0.4%. So a bit of a drop there. The National Association of Home Builders Housing Market Index came in at 72, in line with expectations there. That's the NAHB Housing Market Index. And then finally, natural gas storages came in at 194 billion cubic feet, in line with expectations there as well. And that's about it for the, we also have a long-term, we got treasury purchases going on as well. And I used to really look at, but not so much anymore. All right. Overall markets, we've got crude oil a little bit higher today after the big rally. We were trading in the 59s, and I was talking about this. It just had gotten barely above the 38 Fibonacci level, and then we just blasted off late in the afternoon. Today, consolidating a little bit. It could be just a breather. It could be signaling a bit of a top here, but at this point, we don't know. One thing to note, we have the 9-day crossing over the 50-day. It's not a huge bearish signal, to be quite honest, but it is a short-term bearish signal for a bit of a correction. As you can see, anytime it crosses over here, we get a little bit more of a correction further. We're getting that correction right now, so you know, it could end up looking like this once the 50-day gets below. So a couple of down moves to shake out some of the weaker hands, if you will, but we are seeing that cross. So crude oil could be getting a little bearish. You know, if we get a lot of momentum to the upside, that 9-day moving average is going to peel there, and it's going to end up looking like it just touches the 50-day. But probably going to need at least tomorrow to kind of get us any type of confirmation. All right, we've got Bitcoin futures just right below that 10,000 marker. I think it's pretty much a psychological level more than anything else. As you can see, there's nothing that lines up with 10,000 on the charts as a support resistance, but this is going to be a psychological level. It's obviously going to act as support and resistance just with a big number like that, as people are going to be trying to eyeball it. It tested it Failed. Now we're kind of going up there to look to test it again. It's yet to be seen. I'm not trading it. I'm not long. I'm not short Bitcoin. I'm staying away from cryptos right now. All right, the bonds coming back a little bit after yesterday's big sell-off. We ended up down over a point, I believe. And today getting a little bit of a relief rally. Could just be like a dead cat bounce. You get those big sell-offs and you get shorts covering, and we get that little bit of a bounce, and we call that a dead cat bounce because once those weak hands or those day traders get out, we get another move to the downside. But having said that, you can see this is looking very tweezer bottomous or 3 times down. We're going to have to see where that goes. But I think it's a little overdone to the downside. I don't really think that the Fed is in any position to raise 4 times necessarily. 3 maybe, but 4's a little overdone, especially with the housing market and everything else that's going on, tight interest rates. All right, the VIX slightly moving higher, trying to get up into that 20s again, which we'd like to see, obviously. I would like to see volatility elevated for some time. It's a lot more fun to sell strategies, and I'll talk about some of those that I sold at really high implied volatility, and I'm already out of them. That's the beauty in it. Once you see that volatility comes out, you get out and you can retool and die. Dow Jones Industrial Average up about 80 points. It looks like it's a negative trade here, but that has to do with us opening up higher than we currently are. This isn't like the /ES or /NQ. This is just the average. This isn't a tradable product right here. So it doesn't show up overnight. They only show the day session here. So Dow Jones slightly lower than where we opened is what that's looking like there. A lot of these charts, I'm actually going to flip back through these real quick because I wanted to say something that I forgot to talk about. Earlier today, when the market came back down and was probably trading right around here, and the NASDAQ right around 6,600 or something like that. It was looking very bearish. It was looking like it was getting a little toppy. Now this late it's not late afternoon, but this late morning rally where we're getting the push to the upside, just kind of crossing noon over in on the East Coast, we're starting to get a bit of rally, not making it look so toppy. But if this market comes back down and settles close to unchanged, that is going to look very toppy as a chart. It's going to look like it kind of did a little bit of a bounce. Same thing with the E-mini S&Ps. It's going up and testing that 50-day moving average. It failed earlier. Now we're starting to get a little bit of a rebound. We'll see all that action on the daily market or on the daily breakdown, 30-minute charts. This is a 30-minute candle. Each one of these blue sections is a day section for the last at least 10 days or so. But as you can see, overnight we did go up there and punch sold off as overnight inventory, and yesterday's inventory was still very long. As you can see, shook them out right on the open and have since started rallying back. So we've gotten a little bit of a whipsaw action going as the market's trying to decide. What I was talking about is if we get down here to basically where the lows were right after the open here, that is what's going to make that chart look a little bit more bearish. If we finish up here near the highs, that theory is out. All right. Let's move along because I've been doing these so long, making these these daily market commentaries very long lately, and I'm sorry about that, but I got a lot to go over. All right, so Nike, if you remember, just basically a couple of days ago, I sold the March 60 puts in there, and I sold those for 54 cents. I bought them back for 21 cents yesterday afternoon. I just had a resting order in a couple of these. Meant to talk about them yesterday, but then I got a little in my own head with going about, over 15 minutes on these videos. And knowing you guys, I'm probably putting you guys to sleep, but covered the Nike trade after about 2 days. It felt like an earnings trade. And as you'll see, a lot of volatility has been coming out of these trades, and directional move in my benefit allowed me to get out for a little bit better than 50% of my max profit. Usually, say for instance, on that Nike, I sold it for 54 cents. I'd look to get out around 26, 27 cents. I was able to get out for an extra nickel better, getting out at 21. Similar situation here in Apple. I sold the March 140 puts in there for 63 cents, and I was able to buy those back for 20. So again, better than 50% of my max profit. If you held on to that, or if you followed me in this trade, you're going to be a lot happier, probably being able to get out for maybe 10 cents and at most 15, I would guess, but you could probably easily get out for a dime. And then this is the earnings trade I did last night. I didn't I was playing around with different things and ended up going with this one. This is Applied Material, ticker symbol AMAT. And they had earnings. They have a tendency to beat on earnings, which is why I played this to the upside. And in Applied Materials, in my margin account, I went in there and sold the February weeklies and sold the Feb 43.5 puts. Sold them originally for 38 cents, bought them back for 5. Over in my IRA, I did it with the February weeklies again, but I bought the 42 puts to define the risk on the 43.5 puts. I was able to sell those for 33 cents, bought back only the 43.5 puts for 5 cents. I left on those 42.5 puts. They were trading around, 1 or 2 cents. There's no reason to get out of a long put for 1 or 2 cents. It's a free put at this juncture. And as we've seen just recently, a lot of those puts that I've left on for free are doing pretty well, albeit most of those were had a lot more duration than just tomorrow. So it's going to have a major correction tomorrow in order for me to look to cover those 42 puts. All right, and then on to Qualcomm. These are trades that I've added today, and basically added them because they have high implied volatility, no earnings, great opportunity, right? So with Qualcomm, it's not looking too good right now. It looked a lot better this morning, but as you can see, Qualcomm starting to slough off a little bit. If it stays above this value area high, I'm going to stay in this. But the way that this chart is looking right now, I'm not too thrilled with it, and probably going to be very close on that trigger finger. I was expecting this to pop today. It's not looking that good. They've done pretty well on earnings. I'm not really sure what all this bearishness is about. So that's why I went in there and sold the March 55 puts for 60 cents. Now, they're not looking too good right now. As a matter of fact, they are trading probably close to, I'm guessing, 70 cents, 75 cents. So it's down a dime right now for that directional move. Volatility hasn't come out or done anything. It's just a directional move. I got into that early this morning, and it's going the wrong way for me. All right, and then Netflix, I sold some puts in there. I mean, basically, this past couple of days talking to people, they're talking about all of these new Netflix shows. So I'm thinking that people are going to start flooding into Netflix. As a matter of fact, there's a couple of shows on TV, and this person was saying, I wish they would get on Netflix so that they could be a little bit more edgy rather than regular syndicate TV, if you will, or cable TV. Not like HBOs and stuff like that, but your regular CBSs and things of that nature. All right, so in this, I went into the March again, sold the 230 puts in there for $1.22. All right, so those are the trades that I've put on today, taken off, earnings trades. Speaking of earnings trades that I'm going to be looking at today are Coca-Cola and Deere. There's a lot of other ones, Kraft Heinz Company, Shake Shack. But I'm probably just going to stick with the go-tos of Deere and Coca-Cola for the earnings for tomorrow. All right, so check that out. And tomorrow we're also going to be having a risk reversal webinar. It's a great one that if you have a directional assumption and you want it to kind of act very similar to what the underlying is doing, I'm going to show you how to do that. It's basically a synthetic long position. But we're going to take some of that risk out. And yes, by taking some of that risk out, we're going to take out some of that reward. But it is a less risky strategy than the synthetic long, synthetic short webinars that I've done. This is a little bit less risk for some of you guys that may have a lower risk tolerance. All right, that's about it. That's all I got for you guys today. Other than, if you can't take that, take it easy.